This presentation is going to cover the fundamental concepts that we're going to talk about repeatedly during this quarter. Specifically, we're going to cover 4 topics today: essential issues of financial management, the purpose of business, risk and return, and we're going to review financial statements. There's one and only one purpose that a business exists for, and that is to create wealth for the owner. Businesses may claim to serve other purposes. For example, they may claim to do some great benefit for humanity or to improve the ecology of the planet. But ultimately, if the business is not creating wealth, in other words, if a business is not profitable, it's eventually going to fail, and those other secondary functions are not going to be supported anymore. Businesses that fail lose the jobs. Benefits that are created for society stop. Improvements to the planet cease to be if they're not economically feasible. And for this reason, businesses have to focus on creating wealth for the owners first. The purpose of financial management is to increase shareholder wealth. Financial management is the topic of the course, and so we're going to be talking a lot about the things that are driving the value that's being created for shareholders. Ultimately, you as a financial manager are going to have to ask the fundamental question. The fundamental question which has to be asked in any business situation is, what is this worth? I don't always agree with everything that's in the textbook, and when I have a strong disagreement, I'll point out what it is and try to explain why I disagree. Here's an example. Should managers only take actions which increase the price of the shares of stock? Figure 1.2 in the book goes through this process. The financial manager looks at a financial decision point. They look at the risk and the return and determine if it will increase the share price or not. If it will increase the share price, they say yes. If they reject it, they say no. The first example I'd like to point out is this is what Enron did. Enron took a number of actions which increased their share price well above 100, and I knew people who bought Enron stock on the way down. They were excited when it fell below 120. They were excited when it fell below 110. They were really excited when it fell below 100. But when it fell below $1, they weren't so excited anymore. General Motors is another example. I'm going to put aside all of the illegal and unethical things that Enron engaged in, and let's look at a company which has behaved properly but hasn't necessarily gotten good results. General Motors. General Motors has done a lot of things in order to conserve costs, in order to support their workers, in order to try to create vehicles that are going to be purchasable by the American motorist, and ultimately they failed. They had bad management decisions. They weren't focusing on the fundamentals that create the value of the company. They were focused on chasing share price. Well, what about a successful company? What about the Mars Candy Company? In a classroom setting, what I will do is I will put up the Mars name and I'll ask somebody with a laptop or an iPhone or something like that to look up the stock price for the Mars Candy Company. And if you try that, you're not going to find a stock price. Mars Candy Company is privately held. They're still a C corporation. They're just not a company that has their stock available for public sale, and that means there's no price that's been fixed on their stock. The managers of the Mars Candy Company can't focus on share price, so they have to focus on the things that are creating what's called intrinsic value within the company. The goal is always going to be to increase value. Managers should only take actions which increase value, not just the share price. Now, it is true that the price of a share of stock should accurately reflect the value of a publicly traded company, but that's not always the case. Investors were wrong in the case of Enron. Investors were wrong in the case of General Motors, and investors have been wrong in other cases. Companies rise in price, companies fall in price, but the investors don't have a clear picture of what's necessarily going on within the company. This is why there are managers running the business. They're supposed to act on the shareholders' behalf in order to create that wealth. How do we determine the value of something? Let's come back to the idea of that fundamental question. What is this worth? The example that I use to discuss the what is this worth question is something I call the magic machine. This is not a trick question. It's just a framework I've come up with to help people talk about value and explore the concept. Here's the scenario. You have the opportunity to buy a machine which is guaranteed to produce $100 per month for the next 5 years. There are no operating costs, and the device will vanish at the end of that time. 2 questions. 1. how much would you pay for this machine? And number two, what are the factors that are influencing your decision? What is important to you as an investor when you're looking at this? As you go through and you think about this topic, you're going to eventually come up with a dollar figure that you'd be willing to pay for this, and it's based on the benefit this machine is creating. I put the label magic on there because the function that the machine serves really isn't relevant to our decision. This could be any of a number of things in a business situation. It could be an actual machine which has been bought to produce a product or a part in a factory. This could be a device which is going to reduce an operating cost and therefore improve profit. In both cases, they're going to be creating some sort of a benefit to the company. This could be a marketing campaign. This could be a change to a compensation plan that's going to affect the functioning of the company and the finances of the company. So we need to think about what is this worth in terms of what a proposition is going to do for us. In this case, we've got the simplest proposition that we can come up with. We've got a thing that's going to create a $100 a month benefit over a 5-year period. Factors that typically come into the discussion around influencing people's decision would be, how are they going to be taxed? What sort of a rate of return are they looking at? Why is it going to take 5 years to recapture all of the money that they've put in, and what's their payback period going to be? What other opportunities are available to them? How much capital do they have available to invest? How much is inflation, and do they have to keep ahead of inflation? A lot of different factors come into it, but ultimately it boils down to two elements. It boils down to the return that this machine is going to generate, and it boils down to the risk that the investor faces when they're buying this machine. Now, in this example, there's no risk. This is not only guaranteed to produce $100 per month, but it is magic. Everybody knows that magic works all the time. This is why the internet bubble existed. People believe that the internet was magic. This is why Yahoo made a poor investment in Alibaba in China. They believed that expansion into China was magic. You should always be thinking critically when you're looking at a business proposition and trying to see what's behind the curtain. What else is there that you need to think about? For purposes of this example, we're going to assume that this is a zero-risk proposition. This will happen exactly as presented. If you were going to analyze this, you might draw a timeline. A timeline is going to look like a number line out of any math book, and it's going to start with 0 on one end, and it's going to extend out into the future to cover the number of periods that we're going to have something financial happening. In this case, there are 5 years worth of monthly $100 payments that are going to happen. We'd have 60 points on our timeline, and we'd look at it that way. We'd want to think about what the value of all of these cash flows are going to be to us as an investor and how much we'd pay for it. This is a good time to start talking about basic return. The return is going to be computed by taking the reward that you get divided by the price that you pay for an investment. For example, if you buy something for $1,000 and then sell it for $1,100, the gain that you'd create from that is $100. That would be the reward that you'd get for engaging in those transactions, a $100 gain. To know the return that you're going to get, you take that $100 gain and divide it by the price that you originally paid for the asset. You bought it for $1,000, so 100 divided by 1,000 is 10%. The return on this situation is going to be a 10% return. Balancing out return is the concept of risk. When I talk about risk in the classroom, I use the word uncertainty a lot. In fact, you can use uncertainty interchangeably with risk when we're talking about a financial situation. Things never happen exactly as we want them to. There's always a certain possibility that things are going to be better than we expected, and a possibility that things are going to be worse than we expected. If things might turn out better than expected, we call that upside risk. Everybody loves upside risk, but the thing that we all focus on is downside risk. The possibility that something is going to turn out worse than expected tends to influence our behavior because we avoid unnecessary risk. People in general don't like uncertainty in their lives, but investors in particular are considered to be risk averse. Now, this doesn't mean that investors avoid all uncertainty. It means that each individual investor has a certain tolerance for uncertainty. Each of you is going to have a different appetite for return and a different amount of uncertainty that you're willing to tolerate in exchange for that return. So when we say that investors are risk averse, we're really talking about the individual appetites of investors. And when they're buying and selling something like stocks, if a stock is having too many ups and downs, some investors are going to be selling and other investors will be buying, and the price will rise or fall based on the supply and demand in the marketplace. Think again about the so-called magic machine. If that $100 monthly cash flow was not guaranteed, in other words, if this was a risky investment, how would this affect the price that you were willing to pay? It wouldn't increase the price. It would actually decrease the price, wouldn't it? Let's say the last 3 cash flows are only a 50-50 proposition. Everything is going to come in exactly as planned except for those last 3 cash flows, and there's a possibility that those last 3 might not happen. You wouldn't be willing to pay as much for that machine as you would when it was absolutely guaranteed. What that means is the price is going to go down, and the expected return that you're demanding is going to go up. It looks like this. If we have a $100 reward coming in and we paid $1,000 for a $100 gain, we'd be looking at a 10% return. If we reduce the price that we're willing to pay, we're looking at a $100 gain divided by a $900 price. The expected return that we're going to be getting is 11%. I'd like to stress the word expected return. Expected meaning that's what we anticipate is going to happen, that's what we built into our plans, but because we know that that's uncertain, we're going to adjust the price down to compensate us for the risk that we're bearing. By the same token, if something is less risky, we're going to be willing to pay more for it, which means that, let's say, a group of investors are bidding on a single asset with a $100 gain that could be gotten from it. If the price rises to $1,100, the expected return on that investment is going to be 9%. The general rule about risk and return is this: as risk increases, price decreases. As risk increases, the price someone's willing to pay is going to go down. And as the price goes down, the expected return increases. Therefore, as risk increases, return increases. Risk and return will always correlate. Remember, we're talking about the return which is demanded by investors. It's not a guaranteed result. It's just the result that's built into investors' plans. Investors are going to find a price that's going to give them a return which will compensate them for the risk they're willing to bear. And we're going to call that the required rate of return. The required rate of return may have many labels. I've got some shown on the screen right now. KE, standing for the cost of equity. A lowercase I, standing for the interest rate. RE, or E with an R in parentheses next to it, would be the expected rate of return. Later in the quarter, we're going to be talking about something called WACC, W-A-C-C, pronounced WACC. We'll be talking about the cost of debt, KD, and I'll frequently use the term hurdle rate later on in the quarter. In finance, we've got a lot of standard practices, but we don't necessarily have things codified the same way that things have been put together in the world of accounting. So we've got different terms that we'll use for very, very similar functions. That means we've got a lot of terminology that you need to pay attention to. You will see a formula which is going to look the same, but may have different labels put into it. You may see a formula which has KE or I or WACC put into it, but it's going to be the same mathematical function that you're going to learn to do. Don't let the labels throw you. Just familiarize yourself with them and start to look at what it is that's supposed to be accomplished by the arithmetic. Some other essential issues of corporate governance that we're going to need to talk about are corporations versus other types of business entities, boards of directors, managers, and agency cost. Different forms of businesses are something you should have had in several business classes before this, and so I don't spend a lot of time talking about it. However, I will refresh your memory. A sole proprietorship is put together in order to provide ownership of a business, but without putting a separation between the owner of the business and the business itself. In other words, legally, the owner of a sole proprietorship is the same thing as the sole proprietorship itself. In contrast to this is a C corporation. C corporations are what we're normally going to be talking about during this course. They have shares of stock, and they have a board of directors and managers who represent the interests of those owners, the shareholders. The board of directors is elected by the shareholders on a basis of how many shares of stock each shareholder has. If you think about a share of stock being equal to a vote, the shareholders with the most shares of stock have the most vote, and the most votes puts in the board of directors. Managers are hired and appointed by the board of directors in order to run the company on behalf of the shareholders. So the CEO, the COO, the CFO, all of these parties are going to answer to the board of directors in order to produce results which are in keeping with the best interests of the shareholders. When managers make poor decisions, that may result in the destruction of value. The destruction of value is what I'm going to call agency cost. Any type of a management decision which destroys the value in the company is an agency cost. The textbook talks about a lot of different things. It talks about expenses that are not necessarily altruistic expenses, travel expenses, upgrading to first class, things like that. But it also includes bad management decisions, such as we saw in General Motors. General Motors had a huge amount of agency cost that wound up costing the shareholders their investment. Enron had a different sort of agency cost, and that was illegal and unethical behavior by its leaders, creating a loss of value for the shareholders. Agency cost can take a lot of forms, but really it's just an inefficiency. By hiring an agent to run a business on your behalf, you as an owner are giving up control, and in giving up that control, you're also giving up some of the value that's being created in that company. The goal is to make sure that management and the board of directors minimize agency cost.